In 1971, I clerked on the floor of the New York Stock Exchange. And on August 15th, Richard Nixon, Sunday night, got on the television and told people that the monetary system was going to change, that the money that they thought they could get, gold was thought of as money then, and paper money was like checks in a checkbook, didn't have any intrinsic value, no value, that they would not get because there was a fixed exchange rate, and he gave some sort of BS story about why that was, which it was really because they didn't have enough gold to back up their money claims. And I walked on the floor of the New York Stock Exchange. I thought, this is a big crisis. This is going to be terrible. And I thought the stock market was going to go down a lot. And I went on the floor and it went up the most in years. And I didn't understand that. I didn't understand why. And so I started to do research, and I found that on March 15th, 1933, President Roosevelt got on the radio and made the exact same announcement for the exact same reason. And I studied then, why is it that they went up a lot? Okay, you devalue money. When you devalue money and you make money very easy, things go up. And so I learned not just the nature of that mechanic, but I learned that things that surprised me in my life often were things that never happened in my lifetime, but they happened in times in history. So I studied the Great Depression. I figured, okay, I should study all big things that happened. And I studied that Great Depression. And as a result of doing that, in 2008, I was able to anticipate the global financial crisis ahead of it. And the reason is because when you have a debt crisis and interest rates go down and hit zero, so they can't go down anymore, cutting interest rates anymore is no longer going to work. And what I learned from studying this event in 1933 is that when that happens, the government prints money and buys the bonds. So what happened in 2008 was exactly that. And I wouldn't have understood it if I didn't study what happened back then. So that changed my whole approach to decision making, which is also why I did this study recently, Principles for Dealing with the Changing World Order. I needed to study things that hadn't happened in my lifetime. So we'll get into it. There are things that are happening to us in our lifetimes that haven't happened before, that you have to go back to the 30s or other periods of time to understand. And related to that is this money debt thing. I think that we're at an inflection point, and I think that people do not, economists and people and everybody, policymakers, don't adequately understand the big debt cycle. They understand the shorter term debt cycles, economy's weak, inflation goes down, they make credit available, things go up, stocks and everything goes up until you get too much and you get inflation, then they tighten credit and so on. But the big debt cycle isn't understood, and yet we're there. We're at the brink of one of these. There are really three factors that drive the big debt cycle. Most people think interest rates go up because of inflation, tightness or ease of monetary policy, but they don't realize that there are limits to debt growth. And here's how it happens. One man's debts are another man's financial assets. So when you're holding a lot of bonds, that's a large percentage of the portfolio. That's also a large debt. And think of the credit system like a circulatory system that brings nutrients to all of the parts of the body. So you give buying power. And if that buying power is used to create productivity, then what it does is it produces incomes that are large enough to pay the debts back and give you productivity, and everybody's happy. But if the debts are too large and don't produce the productivity, you don't have the income that's necessary to service those debts. And so in this circulatory system, If it's healthy, you're seeing incomes rise with the debts and you're seeing the system work well. When debts rise relative to the incomes that are needed to service the debt, it's like plaque in the system building up in the circulatory system, because it means that, first of all, you have a debt service problem, that you have to pay the debt service. And that's like plaque in that it leaves less room for spending. So, for example, the US government has an interest bill that's about $1 trillion a year. And if they didn't have $1 trillion, they didn't have that interest bill, they'd have $1 trillion more spending. And that process gets worse and worse over time. In addition, one has to roll over the debt that was last accumulated. So we have to roll over this year a little over $9 trillion of debt. That means it runs out, then you have to sell it again. And when they have a lot of that debt, that's a problem. And when you're putting a lot more debt on top of that pile of debt, so it's not just the existing debt that's a problem, but you have to add more debt sales, which equals essentially the budget deficit, which now is going to be about 7.5% of GDP. You've got to sell those. You have to sell those to people or institutions or central banks or sovereign funds that hold these bonds. Well, they're already holding too many bonds. And now they have to roll them over, and you have to sell these new bonds that are coming on. And that can be a problem. And it can be worse than that, because if they say, hey, there are too many of these bonds and I've got enough and I don't want to buy it, or worse, there could be some reasons that they don't want to buy it. Like, for example, sanctions. Okay. We're living in a world similar to the 1930s. And if I was the Chinese, I would worry that what would happen to me might happen what happened to the Japanese in the 1930s, which is that we froze their bonds, meaning they didn't get their money. Nowadays, with sanctions, too many bonds and so on, when I calculate who are the buyers and how much do we have to sell, I find a big imbalance. And I know how that works. You know, what happens is central banks buy these bonds, they print money and buy the bonds, and then they lose money on the bonds, and you get a negative net worth at the central bank, and you get this spiral. When you reach the part of the cycle that you have to borrow money to pay debt service, and then the holders of those bonds say, okay, it's a risky situation. In the private credit market, we call that the debt spiral, the debt-death spiral. Because when you have to roll over the debts, but it's risky, the credit spreads go up. And when the credit spreads go up, then it adds to the debt service and it becomes a spiral that's a problem. So the way I calculate it is that we're quite near that point. First, start to do the supply-demand analysis. Simple. When that dynamic I described starts happening, you can see it because the amount that is sold is not bought by the private sector anymore, or those other buyers. And then the central bank has to come in and then print money and make up that difference. And then that devalues money. So we saw, let's call it a palpitation. I give this example, it's like a heart attack. We saw that when in 2020 and 2021, when the government needed in 2020 to send out a lot of money, it actually sent out about twice the amount of money that people in their incomes lost or businesses lost. They sent out twice as much amount of money then. And then in 2021, they did it again without the need, but there was a move from a right of center policy to a left of center policy in which universal basic income and the desire to do that put out that money. And so where did the government get the money from? They got it from the central bank that produced the money and sent it out. And so everybody's getting all this money and they're surprised that prices went up. So you have that wave of inflation. That was like a warning heart attack. The alternative has been a problem. It's like somebody who's built up their cholesterol and lived this way, and they say, I haven't had a heart attack, and they get that as positive reinforcement that are the symptoms and the indicators that you're having a heart attack, an economic heart attack, a debt crisis. And so we should be asking ourselves, is that logical? Has it happened before? And then what do we do about it rather than say we don't have to worry about it? You will see a spike in interest rates, a tightening, very much, by the way, these always happen. That happened in 2020. You'll see a spike in interest rates. It will show up as interest rates rising and the value of money going down, particularly in relation to gold or other currencies, perhaps, although this is something that will affect all currencies because they'll all be in the same. They'll all depreciate again together. And you'll see the rates rising, even though the Federal Reserve is easing. Then you will see the Federal Reserve come in and buy and do another QE. And then you're going to see the kind of reaction that you saw back in 2020 and 21, where not only the inflation component, but gold and other asset prices in the sense going up. It'll look like that. What you will certainly see is the Federal Reserve coming in and buying a lot like it did. And it doesn't have to say an announcement, but it'll come in like that, like they did in 2008 or like they did in 2020, except in a bigger way. But what you might have in preparation for that, like in 1971, is certain actions taken to deal with that issue, such as extending the maturity of the debt. These are possibilities. But I think the government would do it such as that country is going to be sanctioned, and therefore to sanction them, we are not going to pay the debt. That would be a very classic, and certainly fireworks should go off in your mind about that signal. I'm not saying it's going to happen, but that is one of those things. And you could see then the government saying that they're going to restructure the debt. They won't say it's a default. They will say, under this policy, we're going to be better off. If we don't default, we won't change what you're going to get paid, but we're going to spread it out over more years. That'll be a restructuring of the debt, combined with some monetization of the debt. In other words, a central bank policy where they're buying some of that debt. That'll look like that. If it gets bad, then you could have more extreme things happen. I don't think it's a depreciation of the dollar in relationship to all other currencies. I think all other currencies will depreciate with the dollar. In other words, it's up to each central bank, and pretty much in terms of other currencies, it's an ugly contest. There's the euro and the European situation, which is terrible. There's the Japanese yen. They have a huge amount of debt, which they're monetizing, and so on. There's China's renminbi, and that's not going to be a safe storehold of wealth. And none of those currencies are going to sort of be what you'd call strong. So I think it would be very much like the 1970s, which was very much like the 1930s, in which they all go down in relation to gold or other hard assets like that. And, what is the alternative money will be the question. What's the alternative money that is stable in supply? Bitcoin might be a bit part of that, could be a big part of that. But what is the alternative money? Because debt is money and money is debt. When I say debt is money to come. You're holding this and people are going to give you money. And money is stored in a debt instrument. When you're holding your money, you're putting it in a debt instrument. So they're one and the same. When you have too much debt, it goes down. So I would think it's more like gold, Bitcoin. What is the alternative money? Money has two purposes, right? A medium of exchange and a storehold of wealth. As far as a medium of exchange, it can keep working as a medium of exchange. In Germany's Weimar Republic or Argentina recently, you can carry wheelbarrows of money and you could still exchange it. They had so much that they couldn't count it, so they weighed it. This is literally the case. So the money can be used for medium exchange, but as a storehold of wealth, it's not going to be used. And people will look for other storeholds of wealth that are movable and tradable. So like in the 30s and then the 40s, what did countries do with each other? They're not going to trust that the other country's not going to print the money or do that. So they exchanged gold, because gold has the attributes. It's limited in supply, it's not easy to manufacture, and throughout history, it's been held by central banks, it's used. Today, gold is the third largest reserve currency. It's the dollar, then the euro, then gold, and then the Japanese yen. And so that's why I'm saying, I think that in that particular dynamic, you say, well, what is it that's the storehold of wealth? I emphasize gold, but Bitcoin too has elements of that. It's not real estate, because real estate is nailed down. You have a problem with real estate. Real estate is nailed down. You can't move it around. It doesn't work that way. It's very interest rate sensitive. So when interest rates go up, it hurts it. It's also very easily taxed because it's not moved. You can easily tax it. So it's not like it can be exchanged. So there's a very limited number of alternative monies. What you don't know about the future is far greater than anything that anyone knows about the future. So we always have to be humble. What you need is a proper diversification to create a portfolio. Gold does well when those other assets that you're typically holding in your portfolio don't do well in such a crisis, okay? So if you're holding, let's say, a lot of bonds or those types of things, the optimal amount in a typical portfolio is in the vicinity of a little bit less than 15%. Like if you didn't know, a prudent amount, that kind of little bit of gold, serves as a protection and diversifies the portfolio. I think the most important thing is that you don't have much of an exposure. Keep in mind in investing, what happens is the biggest problem of most investors is that they believe that whatever has been the best investment over the recent past is the best investment, not that it's become expensive and become too expensive and go down. And so there's a tendency of portfolios and investors to invest when things become terrific. So by way of example, let's say AI companies and companies like that. The thing I want to convey to investors is what's gone up a lot and really done well is a good investment rather than it's become expensive is something they have to watch out for. And that the best company is no more the best investment than the best horse in a horse race is the best thing to bet on, because there are odds and hurdles that are based into the price. So if you're going to bet on a horse in a horse race, you have an equal likelihood of betting on the worst horse to win on, because the odds are shifted, the discount, and that might be the 50-1 shot. And so the markets are like that. It's like a football game. You have to beat the spread. So that dynamic means that you should balance the thing I will really convey to your listeners is that knowing how to balance your portfolio well is a very important thing. This is the most important thing, because what you know is, you can't be certain about, and you can reduce your risks without reducing your expected returns if you do that well. I give many examples. The best mix is to properly mix depressing moves with stimulative moves, what I call a beautiful deleveraging. And what I mean by that is that if you raise taxes or lower spending, that's depressing on the economy. However, if you do that with an easing of monetary policy, which is stimulative on the economy, those two things can balance. And either of them lowers the debt to income ratio, but they can balance each other. And that's a well-engineered move.
How does this play out?
We don't understand how the cycle goes because it comes along about once a lifetime. But there are orders, there are systems, and the systems break down for certain reasons, and it creates cycles. For example, there's a monetary system, and then there's a debt cycle. And so as a result, we now have one man's debts, another man's assets. And when you build these up and you get to a point where you can't sustain that, you have a debt issue. We have a debt issue.